Hello and welcome to a Wealth Advice market update filmed on the 9th of March. We're going to jump straight in today with look at market performance. As you can see from this image on the screen now, this shows the equity markets and how they've performed through 2023. The FTSE 100, there is the top achieving index with 7.15%, shortly followed by the MSCI World with 6.6% and the American indices, the S&P 500 with 5.89%. As you can see, at the start of February, markets went up, went down slightly, went up again, and then came down slightly. But the good thing to note is it's the long-term trend of the year of markets recovering. What we're going to do with this market update is talk about a number of conferences we've attended, which have got insights from various fund managers, and then we'll go on to sort of look at the main drivers of the performance. When we look at the stock market indices over a year, it's still a very volatile message, and as you can see there, the FTSE 100 finishes up the highest, but there's been a volatile ride. When we zoom out further and look over a 3-year, again, that upward trend is shown. As you zoom out, volatility looks less dramatic. Before we jump into the main detail of what's driven market performance, I just want to let you know that the spring budget will be on the 15th of March, and we'll record an update following the budget with any key changes that are announced. We're also going to record a video shortly to think about end of tax year planning, things like ISAs or pension contributions that need to be done by the end of the tax year. Okay, let's get into the main detail now. In February, we attended the Citywire New Model Advisor Conference down in London, and we heard from a number of speakers and lots of fund managers, including Legal & General, T. Rowe Price and HSBC. The overall market view is that they're still worried about recession risk, and inflation and employment data will remain key, as we'll discuss further throughout this presentation. US fourth quarter from 2022 data has been released, and the US was very strong, and there's been signs that the Fed could still achieve a soft landing. In mid-2022, markets thought that US GDP would be minus 2.5% over the full year. However, the US data actually shows that the GDP grew by 2.1% last year. This shows how quickly data can change from negative to positive. Another topic that was discussed at the conference was China reopening and how this can help drive global growth, and this will be positive for all Asian markets. Asia is at a different point of its economic cycle, as the countries are not raising interest rates, so they're not impacted by inflation in the same way as when we're discussing it for the US, the UK and Europe. Another topic we heard about was Europe. Europe was feared to suffer a severe recession, but that doesn't appear likely anymore. 1 year on from Russia's invasion of Ukraine, gas prices have fallen by 85% from their peak and are back to below price at the start of the conflict. This chart demonstrates HSBC's central view for the year ahead. In the first half of 2023, markets could remain volatile as central banks continue tightening interest rates. Company earnings will be key over the coming months to see if profit expectations are affected by these economic pressure. However, as you can see from the far right of the chart, better days are expected. Into the second half of 2023, we can expect to see markets recovering, which is positive for our clients. We also heard from General Sir Nick Carter, the former Chief of UK Defence Staff. We asked him specifically for his views on geopolitical risks, especially China, as this has been a topic that we've discussed with clients recently. He felt that China would be very reluctant to invade Taiwan in the next decade, and his view for this was China will learn from Russia. With the Russian-Ukraine conflict, we saw lots of overseas Russian assets being seized, and China wouldn't want to be hit by these same sort of restrictions in the event of any conflict with Taiwan in the future. This is reassuring because geopolitics can impact markets as we've seen recently, and if China remains stable for longer, that would have a stronger impact on markets. We recently attended the Invesco Investment Intelligence Seminar. Some of the key takeaway points here was central banks are obsessed with the 2% target for inflation. They really want to see inflation fall before they will be willing to think about reducing interest rates going forward. One of the positive bits of news that was discussed was the recession risks are not thought to be as bad as previously feared. One of the reasons for this in general is the oil and natural gas prices are falling, which has been a boost for many economies. Europe is using 45 million less barrels of oil a day now that natural gas prices have fallen again. Markets were pricing for interest rates cuts to be later in 2023. However, inflation staying sticky means markets are now anticipating that central banks start cutting interest rates in 2024. We see inflation in action in our everyday lives. In the supermarket, we see the impact of food inflation, and with many industries striking for pay rises, we can see how this could potentially lead to wage inflation, which will further exacerbate the problem of sticky inflation. Sticky inflation is something that Jordan will come on to talk about a little bit more with his analysis from Elston.
So now we're going to look back at the month of February in review for investment markets. Equity markets continue to recover in 2023 with the FTSE 100 index leading, but this doesn't always reflect a strong UK economy. 82% of the FTSE 100 company sales are overseas, mainly produced in US dollars. This is one of the reasons why the FTSE 100 index is performing so strongly at the moment. It's not that the UK economy is, one of the leading economies at the moment for GDP. It's more to do with the fact that pound sterling is so weak compared to the US dollar. Across the industry, as you can see from this image that we're showing now, fund managers are continuing to reduce the holdings that they have in UK equities. You can see here that $1.2 billion has been withdrawn from UK equity funds in February alone. This means that for 21 months in a row, there's been net outflows of UK equities as fund managers across the country and across the world continue to say that the UK doesn't have as good of a long-term prospect for growth compared to other economies. So we did see a strong start to the year in January as inflation started to move past its peak and markets had hoped that the US Federal Reserve might start to pivot towards bringing interest rates back down. Although we are past the peak of inflation now, we think, we aren't past the problem. Inflation is staying sticky. The realisation of sticky inflation and interest rates staying higher for longer led to markets being quite flat in February and some marginal declines in global equities. US Federal Chairman Jerome Powell came out again yesterday just saying that they think that if the data doesn't show it's the right time to cut interest rates will keep going up. European equities have started recovering as well. This is good news. This is helped by declines in European gas prices, as we talked about earlier, and with there being a mild weather over the winter, European gas storage levels remain high. China's reopening remains supportive for domestic and regional economic activity. This supports our overweight position where we've recently increased our holdings in emerging market equities. Strong US economic growth and employment data indicates that recession may not be so imminent. Strong economic data is usually a good sign, but this month it means that higher interest rates are not yet hurting growth. Markets have had to adjust to the idea that central banks aren't done yet with raising interest rates in the battle against inflation.
Thank you for listening. As always, if you've got any questions, please get in touch. We have had clients who've had ideas that have been used in previous videos, so we definitely value any comments that you might have. Thank you very much.